For today's video, we will be going to talk about China's housing market and economy is falling apart. Evergrande collapse. Let's get started. How it all began. Over 10 years, measures and notices on banks' interest rates, lending standards, receive ratios, land supplies, and policies of affordable housing were published in 2005 and 2006 by the Central Government of China, which includes the China Banking Regulatory Commission, the State, Council, and arms of ministry. Not that at all. The housing market was closely monitored by the government. Additionally, there were new monetary and macro constructions in those identical places in 2007. Additionally, two limiting administrative actions. This was implemented throughout the nation, and generally speaking, the actions had the beneficial effect of stabilizing the housing market. Market activity in important cities slowed down. However, the expansive policies also contributed to a drop in housing values and localized mortgage stress in ghost cities. As a result, the Chinese government began to reassess its policies that were sinking less popular regions, as wins illustrate because they had not anticipated this tremor. Commodity housing had a rapid development during the housing bubble of 2008 due to the Chinese government's prosperity for selling land to developers in order to raise money. Additionally, having a house mortgage, which was the primary means of housing, grew popular. Mortgage finance home ownership became the norm, and the largest single expense for the majority of households was their mortgage. After that, real estate developed into one of the key sectors of the Chinese economy. Due to the prosperity bubble, major cities' housing markets became overheated in 2008, which sparked market speculations. The central government attempted to control price increases through the insurance of regulatory measures, which helped to define the style of housing laws in China's over the following years. Government's mistake. The government began to rely on short-term price controls when they saw that their monetary policies and administrative actions were successful in structuring and guiding the housing market, instead of developing and putting into place a long-term systemic method that would maintain the economy over time. They continued to puppeteer the market by controlling how and when the land was delivered and at what auction prices. They appeared to be taking the classic out of the fire and into the frying pan stance. One thing was obvious: quick outcomes, and they desired to continue riding that train until it broke down, which it finally did. Numerous communities experienced severe local housing reductions and more than 30% drops in home values. These were then followed by outgoing foreclosures. In response, the government implemented initiations to stimulate the economy by employing its arsenal of short-term restrictions, including fiscal and monetary policies, usually referred to as the 4 trillion. The government combined loose monetary policies with lower severe requirements, along with administrative actions to promote the expansion of housing sector. Additionally, they started initiatives to support the securitization of residential mortgage financing. By 2009, the national housing market had substantially stabilized. 2008 bubble lesson for China. The Chinese government has understood that controlling interest rates and reserve ratios have had a big impact on the market ever since the first boom in 2008, and has continued to use these tactics. The housing industry in China is likewise segmented into tiers. The Chinese government quickly discovered that implementing housing rules on a national level holistically might not be totally effective after implementing the initial full economic scale property policies. In order to solve the challenges that can be noticed in each location, the local administration has recently resorted to creating various housing rules for each tier. After the effects of their policy controls in 2008, they no longer adopt a one-size-fits-all strategy. Ironically, throughout any given Chinese real estate boom, specific real estate markets may increase specific real estate markets may experience a downturn, making the Chinese housing market distinct from other housing markets worldwide. China's housing market is distinct, and because of this, determining the macroeconomic impact of bursting bubbles is difficult. The patterns of residential housing are unique from those in the rest of the globe since the government controls the supply of land and its costs. Traditional macroeconomic strategies' abilities to solve housing market issues is complicated by China's ghost towns. In order to control the housing bubble, public organizations and state-owned enterprises stopped building new homes after 2008. In line with this policy shift, demand decreased and the market shrank. China's real estate market is still a major economic driver and has been fully utilized by both private consumers and businesses as a means of investment, while people invest for security and growth. Businesses have continued to raise money through the local government financing platform, LGFP, using the real estate as collateral. Market is out of control. The land is seen as a source of sales revenue by the government itself. Everyone has an interest in it, both in public and private sectors, which fuels rumors. In recent times, the real estate market has been less amenable to government regulations, and regulatory initiatives have had little success. Speculative valuation and real estate purchases have been prompted by the unpredictability of market controlling rules. Beijing's stringent regulations on home buying and selling have had little impact on property prices, which are instead rising. All of this is evident in the current bubble, which Evergrande's housing program has exposed. Residential units owned by property developers have continued to appreciate in value to the point that property prices are growing despite government regulations. The ordinary working adult cannot pay their mortgage due to the high value of apartments, which results in crippling debt that cannot be repaid in a person's life. A festering wound in the Chinese market that had been sloppily bandaged by short-term monetary, fiscal, and administrative policies has been uncovered by Evergrande units. With all of this in place, it appears the Chinese government overlooked the wildfire of speculation and its power to defy rationality, which has a significant impact on house prices. The minimal impact of national policies, particularly monetary policy, has not changed the trend of rapid price growth, and the Chinese government might have extracted the last drop. They will need to think about other options. Some have stated that China should let the market forces settle their differences and only preserve those regulations that are essential to the economic structures through a winning process. The Chinese government, however, is prepared to act. Others have claimed that the market is too significant to be allowed to operate on its own, and that expecting a free market where the operation of supply and demand is allowed to determine the market's own property prices is too unorthodox for China because the government controls supply, which might be disastrous. China needs a new strategy that considers the long-term impact. That much is certain. Because the shocks left behind by the shift implementation of policies from the 2008 boom are what are currently being felt in the economy. The housing market's contraindication reflects Chinese people's economic habits and broader choices. China is currently experiencing both distressed and hot markets. China may need to enact laws that divide the extreme housing market between boom towns into big cities and deserted towns with falling property values. The waters of speculations that are pushing residential prices to surge will come down only the stability and predictability of the housing market are resorted. Through policy regulations, the government manages the supply of land, making it inelastic. Because of this lack of constitutional restraint, the government at all levels now has enormous power to quickly change laws and establish policies more more frequent interventions as a result of government's ability to react rapidly to market changes have drawn criticism for being short-sighted, risk-enhancing, and disruptive to market predictability. However, in China's early stages of development, such regulatory power had a beneficial outcome, especially when the nation experienced capital and financial shortage. The supply of state-owned property was capitalized, and it offers credit to both consumers and developers, resulting in a significant economic reliance on both the governmental and private sectors. But as the housing market matured, it called into question the government's usual course of actions. Such reactionary policies needed to change to reflect the shifting market attitude, and they were best left in the past. The unintended effects of government measures on market participants' expectations are the root of the issue. The government's management and control of the land supply make it appear to be unelastic. However, if the demand for housing stays stable, government regulations put in place to burst possible bubbles may merely be perceived in the market as signs that investing in housing is a profitable business for both corporations and private citizens. After that, the policies stop controlling the price, and conjecture about the driver develops. These may not be the last bubble China experiences in its housing market, as long as the force of speculation is disregarded, unaccounted for, and uncontrolled. If you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.